Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Venture Capital Investing 2024, a complete guide for investors. Your guide to venture capital investing, unlocking opportunities in 2024. Venture capital investing plays a crucial role in fueling innovation and supporting startups. It's all about funding those bright ideas that can change industries and lives. But what exactly is venture capital? Simply put, it's the money given to early-stage companies with strong growth potential in exchange for equity. In this video, we'll explore the ins and outs of venture capital investing. You'll learn how it works, why it matters, and what investors look for when choosing where to put their money. Plus, we'll discuss common challenges and tips for both entrepreneurs and investors. If you're keen to understand this dynamic funding source, you're in the right place. Get ready to dive in. What is venture capital? Venture capital is a significant piece of the funding puzzle for many startups. Understanding it fully can open up opportunities for entrepreneurs, investors, and anyone interested in the world of business. Let's dig deeper into venture capital through its definition and historical context. Definition and overview. Venture capital is a form of private equity financing. It provides funds to early-stage, high-potential startups in exchange for ownership equity, usually in the form of preferred stock. Think of it as a financial booster for innovative ideas. Investors, known as venture capitalists, VCs, take risks by investing in companies that might not yet have proven themselves. In return, they hope to achieve high returns if these companies grow and succeed. So, what's the appeal for both sides? For entrepreneurs, venture capital can mean access to large sums of cash that help accelerate business growth. This funding can cover product development, marketing, and hiring skilled employees. For VCs, the focus is on spotting the next big idea that can yield massive profits, often valuing the potential over the current financials. Here are some key points about venture capital: risk and reward. High risk for potentially high rewards. Hands-on support. Many VCs also provide mentorship, industry connections, and strategic advice. Investment horizon. Typically, VCs expect to see results within 5 to 10 years. History of venture capital. The journey of venture capital began way back in the 1940s and 1950s. It started almost as an experiment to fund post-war innovations and entrepreneurial initiatives. The idea was simple: provide financial backing to startups in exchange for a stake in the company. This concept, however, has transformed significantly over the decades. Early days. The first formal venture capital firms emerged in the United States, notably with the formation of American Research and Development Corporation in 1946. They began funding technology and health startups. Growth in the 1980s. During this decade, venture capital grew as the tech industry boomed. Companies like Microsoft and Apple received early funding that launched them into the spotlight. Dot-com boom. The late 1990s brought a wave of internet startups, drawing massive investment into the space. Although many companies failed, the ecosystem gained much-needed visibility. Modern era. Now, venture capital spans multiple industries, from biotech to fintech. With more global players entering the field, today's VCs are not just based in Silicon Valley. In summary, venture capital has evolved from a niche funding option to a vital part of the startup landscape, showing that the willingness to take risks can lead to big rewards. Have you thought about how these historical shifts affect today's investment strategies? The venture capital ecosystem. Venture capital investing involves a network of players and components that work together to support and finance startups. Understanding this ecosystem can shed light on how money flows from investors to emerging companies and what role each participant plays. Let's break it down. Venture capital firms. Venture capital firms are the backbone of this ecosystem. These companies pool funds from various investors to invest in promising startups. Typically structured as limited partnerships, they consist of management team. This group consists of experienced investors who identify and evaluate startups. They also manage the investments and provide guidance to the companies they fund. Investment fund. Each firm has a fund that is usually raised every few years. This fund is made up of capital from investors, known as limited partners. Venture capital firms actively support the startups they invest in, not just by providing financial resources but also by offering advice, connections, and strategic direction. This dual role elevates the chances of success for these new companies. Limited partners versus general partners. Understanding the difference between limited partners, LPs, and general partners, GPs, clarifies how money moves in this ecosystem. Here's a quick overview. Limited partners, LPs. These are typically institutional investors, like pension funds or wealthy individuals, who provide the capital to the venture capital firm. LPs have limited involvement in day-to-day operations and decision-making. They usually earn returns based on the success of the investments, but they also take on risks. General partners, GPs are the managers of the venture capital firm. They make the investment decisions and are responsible for the success of the fund. They actively seek out startups to invest in and are involved in guiding those startups after investment. GPs invest their own money into the fund, aligning their interests with those of the LPs. This partnership allows GPs to utilize the capital from LPs while providing their expertise to maximize returns. Startups and entrepreneurs. Startups play a critical role in the venture capital ecosystem. They are the engine driving innovation and economic growth. Here's how they fit in. Seeking capital. Startups often lack the funds required for development or expansion. They rely on venture capital to fuel their growth. This funding can be crucial for turning a concept into a product or service. Innovation hubs. Startups often develop cutting-edge technologies or tackle unique market problems. They bring fresh ideas that can disrupt existing industries or create entirely new ones. Partnerships. Once a startup receives venture capital, it typically benefits from the firm's network of resources. GPs provide mentorship, strategic advice, and connections to other businesses and potential customers. In summary, startups are not just receivers of funds, but active participants in the ecosystem. Their growth is intertwined with the investments and support they receive from venture capital firms and their partners. The relationship fosters an environment that encourages innovation and scalability. Stages of venture capital financing. Venture capital financing occurs in distinct stages, each serving a crucial purpose in a startup's journey. Understanding these stages can shed light on how businesses secure funding and grow over time. Let's explore each of these stages, from the initial spark of an idea to scaling a flourishing business. Seed stage. Seed funding is the very first step in venture capital investing. It helps entrepreneurs turn their ideas into a reality. During this stage, founders often seek out initial investments to build a prototype, conduct market research, or develop a business plan. Significance of seed funding. Validation. It tests the waters for the startup idea. Investors want to see whether the concept has potential before diving in. Foundation. This funding helps set a strong foundation for the business by covering initial costs. Networking opportunities. Early funding can connect entrepreneurs with a network of advisors or mentors. Typically, seed funding amounts range from $10,000 to $2 million. It can come from friends, family, angel investors, or specialized seed funds. Remember, this money often comes at a high risk because the business is just starting out. Early stage. Once the seed stage proves successful, businesses move into the early stage financing. This is where the startup has already developed a product or service and is beginning to attract customers. The funds raised at this stage are crucial for scaling operations and driving growth. Common aspects of early stage financing. Typical funding amounts. Generally, early stage rounds secure between $2 million and $10 million. Focus on growth. Investments often go toward marketing, hiring more staff, and improving the product. Investor interest. At this stage, venture capital firms become more involved, looking for startups with strong traction and a solid team. Investors typically conduct thorough due diligence, analyzing market fit, competition, and financial forecasts. This is a critical moment where businesses can either gain momentum or stall out. Growth stage. The growth stage is where startups really take off. Businesses at this stage have a proven model and consistent revenue. They are looking to expand their market presence or enhance their product offerings. Characteristics of growth stage investments. Larger funding amounts. These rounds often attract $10 million or more, as the scope of growth requires significant capital. Expansion focus. Investments might go toward entering new markets, scaling operations, or making strategic acquisitions. Higher valuation. At this point, the company's valuation is usually much higher, reflecting its success and stability. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.